I just read a piece from the op-ed that you wrote with Ben Bernanke.
Yes.
And then I followed up by saying that we had talked to Scott Bessent, and we'd asked a similar question of actually Elizabeth Warren recently, which is, if in fact Jay Powell were to be fired, ousted, or otherwise pushed out, what would the market's reaction actually be?
Well, I think we got a taste of that when President Trump announced that he had shown a letter to Republicans that would call for Chair Powell's ouster. And while the market reaction was brief, what we saw was the exchange value of the dollar declined, longer-term interest rates moved up, and the stock market declined. Now, President Trump quickly said he had no plan to fire Chair Powell, but I think that gives you directionally a sense of what would happen. Look, importantly, markets rely on the independence of the Fed and the Fed's commitment to achieving its congressionally mandated goals of price stability and maximum employment in assessing the soundness of the U.S. economy and their security in terms of returns they can expect investing in the United States. And when a president threatens to remove a chair unless he radically lowers interest rates with the stated purpose of helping the government finance its borrowing, not the congressionally mandated goal of price stability, but to ease financing costs on the outstanding federal debt. This is really disconcerting to markets, and what we've seen throughout history, both U.S. history and history around the world, is when that kind of pressure drives monetary policy in a country, high inflation is the inevitable consequence. And we've seen that in the United States as well. That happened during World War II. Ultimately, in the 40s, we saw double-digit inflation in the United States. And the Fed really rebelled, and there was an agreement in 1951 that the Fed should not have any obligation to help the Treasury finance its debt payments, but rather to focus on price stability and full employment.
Janet, let me ask you this. There is a perception that the Fed has been wholly independent, that historically presidents have not made the kind of comments that this president has, and that this is all new. The truth is that to some degree, this is not new. You can go back 1965. You know the story. LBJ physically shoved Fed Chair William Martin against a wall at his Texas ranch as he was demanding that he lower interest rates. And I wonder, when you start to think about that story, or you start to think about the story that Paul Volcker used to tell about when he was brought into the Oval Office with Ronald Reagan, how we should think about the very concept of the Fed as an independent entity.
Well, you're absolutely right. There have been episodes in the past that we know about now where presidents have attempted to pressure Fed chairs. We've seen what happens when that occurs, and probably the most prominent example would be Richard Nixon exhorting Arthur Burns to hold interest rates down before the 1972 election. And what that ushered in the United States was a period of stagflation, weak growth, high unemployment, high inflation, and it really took Paul Volcker to come in, and it cost us a very deep recession to re-anchor inflationary expectations to get them down. So this kind of pressure, which has sometimes existed, but certainly not, in my experience, not during the Clinton administration or any subsequent administration that I'm aware of, we see that the consequences are very poor for the economy. We end up with higher inflation, worse economic performance, and it undermines the global role of the dollar and the willingness of foreigners to invest in the United States.
Secretary Yellen, on that point, there is a lot of concern about President Trump inserting someone from his administration directly into the Fed. There's this idea that the Fed is supposed to be apolitical, but I wonder if you think that that was broken down to some extent when you went directly from chairwoman of the Fed to the Treasury Secretary, going directly into an administration, Lael Brainerd doing a similar move with that. I just wonder if you think that that door between the administration and the Fed should be closed a little more tightly, more of a Chinese wall to prevent any sort of perception of a lack of independence at the Fed.
So it has not been uncommon. Many Fed chairs have had past experience in the White House in an administration. This was true of Greenspan as well. And I suppose it's natural because presidents come to know people who serve in their administrations and gain confidence in their judgment. What's really important, though, is when an individual is wearing the hat of Fed chair, that they have the capacity and willingness to make fact-based judgments and to pursue the goals that are congressionally mandated, namely price stability and maximum employment. That becomes their job, and they have, I believe, whether it was myself or Bernanke or Greenspan, I think all of us were able to establish a track record for independence, staying out of politics, not succumbing in any way to short-term political pressures, behaving in a nonpartisan way. And the track record, by and large, although all of us are human and may have made some mistakes, I think the Fed's track record over many decades has been one that's been successful. We've had low and basically stable inflation. The post-pandemic experience was an exception, but look where we are in the economy now. Inflation is coming down, and it's close to the Fed's 2% goal. The labor market remains strong with 4.1% unemployment, and really the United States was like every developed country that experienced a surge in price pressures during and after the pandemic.